So welcome everyone. And before we start the event, I wanted to do a quick intro to the CMU T&E community. So we are a global community with more than 6K CMU alumni, and we host various events under Startup School series. And also we have industry insights and founder stories. Apart from that, we have happy hours and many different micro communities that each focus on their own interests. One that might be of particular interest to this group is the Builders community, which hosts a ton of great events relevant to someone just building out an idea. Overall, the community is just a great way to connect with other CMU alumni. If you would like to get involved, please join our Slack space and mailing list. I'll drop the sign up link in the Zoom chat. Now let's kick off our event, which is how to raise funding. So first-time founders usually struggle to raise their first round of capital. As part of the CMU T&E Startup School's event series, this speaker event provides future founders a guide to fundraising. So our speaker for the event tonight is Abhi Sharma, who is a co-founder and co-CEO at Relyance.AI and an advisor at Unusual Ventures. Before co-founding Relyance.AI, Abhi was also a founding member and head of machine learning and analytics at Foghorn. He received an MS in computer science and software engineering from CMU. And now I'll hand it over to Abhi.
All right, cool. Okay, well, thanks, KP, and thanks to, I guess, everybody who's in the organizing community for CMU T&E. I think you guys have done an excellent job in getting the full group together and actually build a CMU community to help each other out. So excited to be here. I think what I'm going to do as part of this session is I have a few slides to share, and I'll walk through, I guess, a certain core principles for fundraising. I'll also quickly introduce myself from the context of fundraising so you guys have some credibility on maybe why you should listen and you're part of this session. If there are questions, I'll probably take 2 or 3 specific stops within sort of my talk so we can answer some questions along the way. If there's anything interesting or super burning, then KP, I'll look to you to watch the chat, and if there's something interesting, feel free to interrupt me at any time. Before I start sharing my screen and dive in, one thing I want to highlight is sort of motivations on why people do things. I always like to understand, so I guess I want to be upfront about my motivation on doing a talk like that. I think there's a lot of, or I fundamentally believe there's a lot of information asymmetry for first-time founders, sometimes even second-time founders, into what goes on with respect to a fundraise versus venture capitals, venture VC firms who probably do it on a daily basis. And I think my goal of at least participating was to help, let's say, level the playing field a little bit. So let me get the screen share going, and I'll talk about sort of I have a little slide deck, and I'll just go through it. All right, so KP already introduced me, so I won't kind of go through it again. But in terms of, I actually recently just raised a Series A round, a pretty large Series A round for my startup Relyance.AI, which was 10 months after my seed round. I haven't put numbers in there just yet because we're in stealth, and we'll be launching the company out of stealth late August, early September. And so you guys have more details, but needless to say, cumulatively, I've raised over $200-300 million in my career so far. And I've also seen the fundraising environment as a founding engineer, as a founding member, as an advisor on the venture capital side. So hopefully I can offer a holistic perspective. If you have questions, of course, like I said, I want this session to be interactive, and generally what happens through Q&A, I'll end up covering subjects or things that are useful for everybody. So feel free to just, I don't know what rules and regulations you guys have, KP, but if anybody has a burning question, I'm open to being interrupted so we can talk through it. I want this to be super actionable. That's why the Q&A. Couple of things I want to talk about. Like generally going into fundraising, it's actually one of those scenarios where looking at the average is okay to set expectations for yourself, meaning there are always going to be anomalies. You'll always find a one-off company that ends up raising $300 million while you're struggling to even raise 3 million. And rejection is a very common attribute of just fundraising. So, whenever you're trying to build something and go into fundraising, just assume it's going to happen and don't shy away from it, I guess is what I'll say. Here are the way I like to do this session is cover the top like 10, 12 bullets around what are some key principles around fundraising and how to look at it. So where you can start from fundamentals 101 and then go into sort of the core tenets around fundraising. Now, just to kind of talk about each of these pillars in a structured format, let's go through, first of all, the key point on deciding to fundraise. Because I think as an early stage founder, that's one of the most critical decisions you make on sort of deciding to fundraise. And it's important to understand like why you want to do it, right? I would say that there are different ways and people are kind of looking at deciding to kind of fundraise in different ways. The first most important decision you can make is, first of all, committing to the idea. And this is fine whether you're still in school, whether you're thinking of your startup, whether you have made the decision, either structure is fine. But it's super important to first commit to yourself and actually make the decision that you want to actually raise venture capital. Sometimes people just assume that you're building a company, so you must raise money. And that's not always the case. Sometimes it's better to bootstrap something before you decide to even raise money because it might make the fundraise easier. So, and it's sort of a long and complicated process. So it's very important that you feel you're committed to jumping on this product, on this thing that you're doing full time, and have a broken up framework of why you want to do this, like how much money do you want to raise, why do you want to raise money, and just do a basic back of the envelope calculations around okay, why is it that you need money? If you're two or three co-founders, you really don't need a lot of money to build your app and showcase value. I recommend you do that. But sometimes if you're building a complex product, or if you're building, I don't know, self-driving cars 2.0, you might need money to even bootstrap your operations or even kickstart with what you're doing. So it's very important to ask the fundamental basics of like, do I need venture capital? Can I get a loan? Can I get self-started? What am I trying to build? And then going back to a spreadsheet and just doing a basic math on what will you need, how many people, where to get from, and then start to build out on, do you know even any venture capitalists or not? And this is sort of what I like to call the pre-test before even diving into this, to just understand and ask the most fundamental basic questions to see sort of where you land. After you've done that and you've kind of literally checked box these things, and that's why I have the bullets as check boxes. You can literally check these items and then you'll kind of have a good survey of like, where do you stand and what you want to do. After doing that, you want to actually understand where do you fit. And this is very important to understand during fundraising, because enterprise and consumer businesses, in the way the businesses operate, in the way the businesses grows, in the way the businesses are structured, they're very, very different. In fact, raising funds for whether you're building an enterprise company versus building a consumer company, the process and structure is fundamentally different. And in fact, right now, and at least in the Silicon Valley, and actually that's true for East Coast too, you'll find that VC firms will have expertise in one of these areas, or if not, they will split their internal teams into these two areas. So obviously it's obvious to you as a founder on whether you're building enterprise or consumer, but also figure out, are you targeting VC firms that specialize in these areas, and who are the specific founders? And this does require, since all of you guys went to school at CMU, potentially you all did an exercise in a spreadsheet on like which university should you apply to, why do you care about this university, which one's better than the other one, and the structure around that. So it's super important that you kind of make a spreadsheet along these dimensions. Enterprise startups end up, one fundamental differentiation that I'll tell you from a venture capital perspective right up front is enterprise startups, there's a better understanding of what the business can be. People can project and validate the need, people being venture capitalists, with their internal groups or advisors very quickly. And then there is also a lot of pre-validation you can do for, even if you're before you've built your product or you've have some customers, to get a sense for, do people want what I'm trying to build, or is there a genuine problem I'm trying to solve, and does that problem exist at scale? With consumer startups, it's like a lot of people will give you a lot of leading indicators for product market fit, but it's really anybody's guess. And any VC who tells you, or anybody, pretty much any advisor tells you, I know the recipe for consumer startups, is pretty much lying. Nobody really knows. Like, it's very hard to figure out why network effects for certain things work, and the timing. A lot of variables have to align. So the only thing I would say is that in consumer startups, the ramp up time does require you to have a much more clearer plan, typically a built product, and typically some people in a wait list, or at least people interested in using a product. That is super important in consumer versus an enterprise. So just understand that if you're trying to do this for the first time, understand where you fit in, because that might totally sort of split the way you approach your fundraising structure. So that's super important. Couple of things on pre-work. So we talked about sort of the decision framework for whether you want to raise money, why you want to raise money, and asking yourself the fundamental questions if you're willing to commit to this. Then, I mean, it's obvious to think about enterprise and consumer startups based on what you do, but the split is not so obvious when you get into fundraising, because you have to understand the fundamental differences, and therefore the VCs you target, and how much work do you do up front before you even try to raise money. And in consumer, I always recommend people to have something ready to go. If you can show some traction, that's even wonderful. Now, before you start fundraising, and when I say fundraising, meaning before you even get an introduction to VC firms, ask other founders, ask angel investments. And by the way, that's another, I guess I'll throw in a plug for myself here. Sometimes I end up doing angel investments myself. So if, post this talk, if anybody's interested and you would like to talk, I'm happy to have a conversation based on, if time permits. But coming back to before you approach fundraising, and it doesn't matter what it is that you're using or what it is that you're building, you have to make sure that these checklists are sort of, checked off in your building a fundraising experience. And I know this seems like almost a prescriptive recipe, but I spent a lot of time on trying to really figure out, what are the most actionable questions founders can ask themselves. And then from a venture perspective, having been on the other side, what are the key questions everybody is looking to answer? And if you have this magical set of artifacts, of course, there's no silver bullet, and then there's always nuance to what you're doing. But I feel if you can answer these questions, I'm not going to read through all of this, but if you can answer these questions, you'll have a much, much stronger sort of clarity in your own mind, and a stronger set of artifacts. You can go into the fundraising process feeling super confident. In fact, the first bullet I want to double click on, why anything, why now, and why you. If you ask some of the best CEOs in the world, especially in the enterprise space, if you can answer these three fundamental questions over and over again with greater level of refinement, you can totally nail down your sales process, and also is very helpful for your fundraising process. In fact, if there's nothing else you take away from this talk, and if you just remember the three whys, it's very important. I mean, if you ask the CEO of MongoDB, who's a great friend and an advisor, he'll borrow just his wonderful one-liner advice is ask the 3 why questions. So coming back, you want to pretty much have all of these materials prepared. Do the first draft with your co-founder or your team, or if you're a solo founder, that's fine too. You need these artifacts. The prototype of your product could be optional based on what you're building. When I raised money for Reliance, we didn't have anything. It was pre-team, pre-prototype, everything. So you can raise money even if you don't have a product, but the rest of the thesis has to work. The other thing is you have to kind of do a first draft of all of this thing, put this aside and come back to it again as if you were rejected. And then as you revisit this, you'll refine it with every iteration, if you will. And then once you have, don't talk to anybody about your idea, about your product, about what you're trying to do. I mean, apart from your friends, unless you have nailed down these sets of artifacts, because the act of writing this down helps you go through this process in a very refined way. And it's super important you get that nailed. Once you have this and you've revisited this, you can start to talk with a few investors if you want. And if you want to talk to friendlies or people who have raised money, they can give you some initial feedback. And then once you are ready with all of these artifacts, you can then go further. One thing to remember is for venture capitalists, right, who are trying to invest in founders, they are very interested in learning about new ideas, new businesses, new founders. Otherwise, they would not be VCs. But the golden truth for all venture capital is their returns work on power law distribution, which means they know 80% of the stuff they're going to invest is not going to work. The 20% of the stuff that is going to work so well that you'll get the Ubers and the Airbnbs and the Googles of the world, and therefore it will return their fund and then some. And also realize, apart from angel investors, a lot of traditional venture capital investors are not investing money out of their pocket. They have limited partners. They create a fund and they invest out of that. So they're required to do a lot of diligence and research before they fund anything. And these are some of the key things they care about. Why are you the best founders? Credibility of you as the team. Is there someone desperately looking for a solution? All these things matter a lot. Now, sort of going from there on saying, like, say you have done your pre-work, you have these artifacts nailed, you can ask there's a lot of templates online. You can ask your founder friends or somebody like myself for some help within the community as a first line of review. And then you can sort of start to approach your fundraising process. Now, there's a very nice algorithm on pretty much what is your likelihood for getting funded. If you're a second-time founder, your likelihood is super high because you've already built your network, you've proven, especially if you're a successful founder. Even if you're unsuccessful first, second-time founder, you still have a network. For people who don't have a network, I think this is a spectrum on how likelihood of funding works. If you're a solo first-time founder, your likelihood is super low. So I recommend you find co-founders. Now, it's not a golden rule of thumb, but generally the journey is hard enough that it's hard to manage anything even when you get to 10 people all by yourself. So having a good, strong co-founder, and people typically look for this in at least the venture capital world, because it's hard enough on this journey that solo founders rarely work, although of course there's exception to everything. And so I would literally say first-time co-founders have a higher likelihood, especially if you have complementary skills, than getting funded than solo first-time founders. Then the pre-team, pre-product, which is where I was, but obviously I had some credibility having built before. Team, having a product and a team and a prototype is better. Having a product which you can demo is even better. And of course, if you have traction of any kind, your likelihood is much higher. In fact, if you have great traction, venture capital firms are always on the lookout to find new deals. So they'll probably be chasing you. Then I think from there on, I want to talk about the process. This part is very, very important. So like if I were to summarize, and let's go back here for a second on how much we have talked about, because it's easy to then lay context, and then I'll talk about this again. So first of all, you have, and you can, I've tried to make the slide deck in a way that it, once you have access to the deck later, you can literally use this as a checklist, as if it was, you were using it for packing on your road trip. And I've tried to design it that way. So far we've talked about, well, first of all, your own mental readiness, because you need that. And if you're not 100% confident, don't do it. Like, I would say that don't go into fundraising or even building a company half-hearted or unsure or confident, not confident about what you want to do, especially with fundraising process. Because at this early stage, at the super seed stage that you're raising funds, people and venture capitalists are investing in you as founders more than anything else, because there's no data. You might have some customers, might have some prototypes. People know that startups pivot over time, they change a lot of things, markets change. They want to look at the macro picture, but you're totally defeating or setting yourself for failure if you're entering your fundraise phase without being 100% confident in your heart that there is something here and you really want to do this. So use that checklist first. And there are some very basic questions that, I would even encourage you to write answers for yourself. You don't have to share with anybody, but if you can answer those things for you with a bulleted checklist, you'll feel much confident. Understand where you fit with enterprise or consumer, and then therefore decide where you are for the likelihood of getting funded. If you're a first-time solo founder and you're building a consumer startup, like I would keep this metrics in mind, and I would not try to do fundraising if you're at this bottom layer of this tree here. If you're building for enterprise, I would at least have a projection of who my co-founder's team is and a prototype, if not a well-flushed product. That increases your likelihood. So remember where you fit. Then the pre-work for fundraising, I would say if you're a first-time founder and you're trying to do fundraising or send a slide deck or ask somebody for some review before you have not checkbox, and I would always take the, I would almost be a little bit more prescriptive here. And if you've not checked every single box here, I feel you're just setting yourself for failure. Unless you just have a great connection with somebody and then it just works. But that's just mostly, one-off anomalous incidents from a structure standpoint, process matters. And so the first 4 bullets was to, really deciding where you land, doing your fundraising pre-work, and then seeing where you fit in this likelihood of getting funded, because based on where you fit, you have to navigate your fundraising process accordingly. Like in my case, I was pre-team and pre-product, but have had built things before. It's a very different dynamic than first-time co-founders. So you want to basically see how much credibility you want to build before you enter the fundraising process. All right. So that's the summary of, like, I guess the first 4 bullets. Now, this point is super important around process. I think process matters a lot. A lot of people underestimate it. So let me double click on this a little bit. And let me get this screen share going with you again. Run your fundraising process like pretty much when you applied to schools at CMU, or pretty much whenever you decide to do your bachelor's or master's or PhD. This is one area that founders get wrong a lot of the times, and it's super important to nail this process when you're doing this. So what do I mean by nailing the process? Andy Rachleff, who's the founder of Benchmark, which is one of the best VC firms out there, and also has been an advisor to me in the past, he calls this, and I learned this from him, he calls this off-Broadway testing. And what this means is, just like you have Broadway, where you kind of run shows off Broadway, see if they do well, then you promote them to Broadway. You can apply the same principle around VC funds, right? Once you've done all that pre-work, you're ready with your material, literally run this process like a spreadsheet. And what I had ended up doing, and I have at someday I hope to publish a Google Drive with all of these templates ready to go that work for me. But just to describe this verbally, I would take a list of like venture capital firm, how do you rate it? Sort of, do you have a direct connection? Do you know somebody there? If not, who are the best partners for you? Why they are the best general partners? And what tier does the firm fit in? You can rate out of 5 stars based on your own judgment and your fit for your startups. That's the big thing. And then you can split them into firms that you care about a lot, firms that are like, okay, firms that you maybe don't know or don't care about so much, and run a process with a few firms one at a time. Because once you pitch to somebody else for the first time, you'll get some feedback, you'll get a bunch of questions maybe you didn't anticipate for, you get asked something you didn't think about. So focus is very important. I've seen a lot of founders, once they're ready with their deck, they'll basically try to do, hack this as an analytics job, and they'll put this in DocSend and send their deck to like 500 people. That's, in my opinion, it might work. Again, there's no silver bullet here, but it's not the best way to raise quickly, because you're just like doing this let's just do a blast and see what sticks, and that is never the right process. In fundraising, especially if you want to go it really seamlessly, you really need to connect with the firm, the founders and the general partners need to connect and lead the process. So what I would say is spend more time aiming the rifle rather than firing blind, which means, and taking that one or two headshots that are going to work, if you will. What I ended up doing is get 3 or 4 firms at a time and then batch them and start to develop relationships much before you're actually raising, right? This is kind of what happened with Reliance, where we did a fundraise process for our seed round, but for our Series A round, if you ask me today, I don't have a Series A deck. We just got completely inbound for raising our next round because we have sort of nailed the right relationships and helped build sort of, even they're completely in stealth, but at least within the investor community, a posture for what Reliance is and was going to become. And these handcrafted, slow process conversation help, even if there's an investor that rejected you earlier, they might come back in a future round. So it's important to keep those relationships alive. Then finding a lead investor is super important. Sometimes these days, the seed rounds have gotten really big. Some people are raising 4 million, 5 million, 8 million as just a seed round. So some investors will do the whole round, but many times you'll have a pool of investors if you don't have credibility from before. Investment is a lot of like signaling effects function. So getting somebody to commit to your lead investment is important. So if you're raising 5 million, somebody is ready to do 3 or 4, and then you can have other investors pool in after that, right? And it all kind of works in a step function. So don't try to hack the process or scale the process. This one is very similar to dating, where you really have to spend time to figure out if this works or not for you. So, and running this process, tracking what you felt, tracking your notes, figuring out whom you connected with, maintaining the spreadsheet of low, high, medium priority investors according to you, and trying to talk to investors that have a better fit is important. And this is the process where you can actually spend time talking to the junior folks in VC firms, because they're typically working for deal flow for their general partners and are much more likely to take your meetings. This is useful because you're not quite ready to raise yet, and you're setting up sort of the blueprint to basically do your raise. And this process is super important. Don't try to kind of just fire blind and try to find VC firms. Typically doesn't work unless somebody is very aligned to exactly what you're trying to build. So process is super important. Now, of course, okay, you nail down a blueprint of the process. What does an insanely good pitch look like, which is typically getting you funded? And again, I'm going to talk about this from an early stage funding perspective, which is seed and Series A, because this is sort of how to raise money. Post Series A, the whole fundraising process becomes completely different. And I'm happy to talk about later on one-on-one if somebody's in that situation. But for an early stage, you need to have a good pitch deck. And the key things to realize in that pitch deck is you are still, at the end of the day, at this early stage, selling a narrative and selling a story, because you don't have enough credibility or numbers or customers or finance metrics to show off that you're a working business, right? And at an early stage, what people are really investing in is basically your company and nothing else. The other thing is the component here, and I'll give you sort of, if you see, and I'll talk about the next slide where I'll give you specific essentials on what needs to be in this deck, but I want to talk about what does an insanely good pitch deck look like from a qualitative perspective, and then I'll get into the quantitative perspective. From a qualitative perspective, you need to have these ingredients. And the best analogy, if I want to describe on what does a great, and this is my personal bias, but personal perspective that has worked, is if you've seen the James Bond movie with Daniel Craig in it, Casino Royale, there's an opening scene, which is a chase scene where he's basically chasing some guy in Africa or Namibia, I forget where. That scene is what your pitch deck needs to feel like. It's simple, but it's unexpected. There's a lot of ups and downs. It's an emotional roller coaster journey. You're being credible. You have an opening gambit, which gets me at the edge of my seat. And then it has to be a story. Put yourself for early stage pitches as if it has to be credible. And that's why I added that point. You don't have to sell a completely, narrative that doesn't make sense, but the credibility of what you are and why the story works has to fit. And it has to have emotional angles. Think of a movie director at this point when you're thinking about the qualitative pitch. So I would say many times what people will do is they'll look at seed or Series A pitch decks, find the seed deck for their favorite company. Like if you really love Airbnb and you're building a consumer startup, you'll search for Airbnb's deck, look at 10 decks, borrow some ideas from there, and stitch all that together. And there's nothing wrong with that process. What I would say is, like, once you're done with your draft and you're feeling good about it, revisit this slide and see if you check box each of these elements within that deck. Like, is it clear? Is it simple? Do you have an surprise element? Something should be unexpected, because if it's simple, people will fall asleep. And then it has to be credible. Now, talking about it from a quantitative perspective, here are some things that you must have in your deck, which is sort of an emotional credential connection to you, right? When you're raising money at the seed or Series A round, you're still super early enough. You're telling a story. But the first thing for me as an investor is like, why should I believe your story? Who are you and why are you the perfect person for this, right? Talking about the problem and solution in this different way in a typical story with a climax in it is a classic way to tell stories, and there's nothing wrong in doing that. And towards the end, I have some book recommendations. There's a book called Presenting to Win. It's a very short book, and if you haven't read it, I highly, highly recommend it. It is, I forget the name of the author, but it's one of the guides to some of the best people who have raised money in the Valley. If you have any traction, that's awesome, or your go-to-market strategy. And then obviously just ask for what you want after that. The why now piece is super important, because when you're raising your capital for your company, people will ask you this question, like, why would this not be true? Why, if this was done 5 years ago, why would it not have worked? What if this is done 5 years in the future? Why should that be true? Like, why is it now that this needs to be built? And that's the one component that a lot of founders forget, in my opinion. So it's very important to double click on that. Rest of the quantitative recipes you'll find with different slide decks. And then be very clear about your ask. And finance timelines work really well, where you can say, I want to raise 5 million from here to here, then I want to do blah, 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 and kind of create a structure around that. So that's it. I'll pause here. And like I said I'll take a couple of pauses. So I think we covered, I'm going to revisit my agenda here. We covered likelihood, process, good pitch. I'm going to talk about investor perspectives. I'll take a pause here in case anybody has any questions, or if there are votes for certain questions.
I don't see the option to raise a hand, so I have a question. Is that okay, mods? All right, can you guys hear me? Can you hear me, Abhi?
Yep.
Hi, my name's Tyler York. Great to meet you. I'm loving the presentation so far. We're looking at fundraising in a few months for a seed round, and one of the things that I am struggling with is really that storytelling aspect. How do you capture the attention of investors quickly in the presentation, especially when they've seen so many? And particularly because we're in education technology, which is not always the most exciting, right? Like, it's not consumer, it's not VRAR, et cetera. So I'm curious, You're just looking at what I could from your startup. It looks like machine learning and privacy. That's not necessarily quote unquote exciting either off the top, right? So I'm curious how you were able to capture attention with your pitch.
Right. I'll give you a two-part answer. So I'll talk about the second thing you asked. Great question, by the way. In fact, it's very true for Reliance, where we are doing machine learning, software instrumentation for privacy, data governance, and compliance. One of the most boring subjects, if you will. But what I said was, okay, boring. Yeah, the best way to describe and get investors' attention in that scenario is look at the total addressable market. So the way I sold Reliance was like, okay, if you look at Reliance, it fits in this quadrant of unsexy but technically challenging with a very large market, right? That is typically the recipe for a monopoly business. And that's what they are looking to hear. And a credible story behind it, by the way. Because and examples like, let's look at accounting software companies. There are only 3 companies in the world that typically have large market share: Intuit and Xero and QuickBooks. It's kind of boring. Most of all of the engineers are not spending their time to build that, which means they literally have 80% of the market share, which is great from an investor standpoint, because I'm looking for power law distributions. So you need to have in our case, my angle was boring area, technically challenging. Nobody wants to build this stuff in-house, and everybody must have it. It's like almost like HR software. You can't run business without it, no matter how small or big you are. You combine all of these variables, you fit into a quadrant of what can make a 0 to 1 business, as Peter Thiel likes to call it. And that's attractive from an investor standpoint. And then you can basically layer in your wedge about why you're fundamentally unique in this market. You got to give them some lever to pull where you can totally be the outsized outcome. And so that's one angle on better storytelling. The second thing in terms of like how to capture attention and storytelling, especially in the pitch, and this goes back to running a when-led process, is because especially if you're in an area that is not new, and I'll touch upon a couple of these subjects further in the presentation, it's a crowded market space, then you have to nail finding investors or building relationships with people who are likely to be informed and educated about your domain. So like, for example, if you're building an education software, there's no point for you going to try to pitch to Martin Casado from A16Z or Andreessen Horowitz, because like he's security related guy, he doesn't understand this stuff. So even if you know him really well, there's no point, because that investment is not going to work. So I feel like in that case, process matters on finding a good, refining, and really finding the right fit with investors, and then playing on the emotional angle of your deck. And at that point, as much as you can get a meeting with somebody where you're not sharing your deck up front and actually walking over the presentation, that makes a big difference. This is one of the biggest mistakes I see people making. Well, they'll like highlight, oh, we have this many metrics and we have 3 customers, we built the product, here's a blast update. And they see so many of them, then they're judging the deck based on their perspective and their point of view versus what you have to educate them on. Almost like investors, and I'll say one more thing around this and shut up, is investors look for those, they live by the number of aha moments you can have in a deck with them, where from a macro perspective, they was like, oh shit, we didn't think about this in this particular way. So for like Reliance, where it was a cool, sort of uncool, sort of not so sexy business, at least the pitch of the company, we said we have the most shift left perspective for that. We're actually embedded in the SDLC lifecycle. And then it suddenly makes them go, aha, I never thought of compliance in that way. And that's an aha moment. So the number of aha moments you can have within your deck, especially if your only opportunity is to communicate by a piece of artifact, then you want to optimize for the number of aha moments per second. That will almost predict your success. And what you can do is, as a practice, talk to people like myself or fellow founders to see how many of those ahas you got in the demo or the deck. And that's like a practical, measurable criteria you can see of likelihood of people actually paying attention. So those are that's my feedback on what's best.
Thank you so much.
Any other questions? Mm-hmm.
Yeah, I had a question. I think the HQ put it up in the chat there. But you mentioned that enterprise businesses, like traction doesn't matter as much. So I was curious, like, why that is, and then also, what does customer acquisition look like in the enterprise space after that?
Yeah. So I guess, yeah, great question. I think in the enterprise space, what typically happens is the couple of things that are true for enterprise. Number one, enterprise products are inherently or expected to be, that's changing now in the market, but like people expect enterprise products to be heavyweight, lots of features, customization, implementation time involved. So the whole buying and go-to-market motion in enterprise, there is the inherent training in the market where you kind of, you don't expect a Robinhood like simple experience to buy a stock in enterprise. You can expect a journey for implementation. So that's the number one reason where people just kind of have a little bit more higher threshold on saying, oh yeah, enterprise products, we kind of take time to implement. That's number one. Number two, it is very easy for, or relatively easy for venture capitalists to verify, is this a pain point? So what they will typically do here is, let's say I'm a VC, you're pitching your enterprise startup to me. What I'll do is, like, I already have a portfolio of companies, I know a bunch of people, I'll just introduce you to like 5 other people. And then you'll do your pitch with them and I'll follow up with them to see what they have to say. And then I can do a very strong analysis if there's a common trend or pattern of this problem existing everywhere. So that's the second thing, which is easier to do in enterprise versus in consumer. Therefore, you don't need to have a lot of traction. The third thing is, in enterprise, typically there is a much clearer either technical or product or workflow related differentiation where you can clearly evaluate what you're building and then also overlay with, is this a problem across a large scale of market on a repeatable basis? The validation is easier as a venture capital. In fact, you will also get a lot of companies to take your calls in enterprise and say, if I made this and this process easier, would you pay for this? And they'll say, yeah, I can even act as a reference to your venture capitalists, which is what we did at Reliance. So I think those combinations, and then the final thing is the sales and the go-to-market for enterprise is like, to begin, you can bootstrap this with a very like well-known arenas of like, what do you need? Like, who's your primary buyer? What are their pain points? Why would they pay? And even if they're not ready to pay, would they try their product? What's the pricing? Like every aspect that matters to measure a quality of business and its success is, at least there is some math that as a venture capitalist, I can run to ascertain if this is good or bad. In consumer, it's just like for example, I'll make this very concrete. In Reliance, we raised $5 million as seed round without a product or a team or anything. But we said, well, you need an ML instrumentation and shift left for privacy and data compliance. It was very easy to know that regulations are changing. Everybody wants to do machine learning. This is a big pain point. So if these guys can do a good job, there might be something interesting here. With consumer, let's say you're building LinkedIn for the first time, it's so hard to find what network effects would be and if people even want this, because you have a certain dimension or interest in what you realize. And then, like, you've seen this many times, that you could have 6 products which do exactly the same thing, but somehow only one product wins. Like whether you think about stories, like Instagram, I don't know which one's most popular, but like maybe Instagram and TikTok stories are super popular, while Snapchat and LinkedIn and Twitter has the same feature and nobody uses it. So that's the reason why for a venture capital to do the math on why a consumer startup would work is so much more harder. So if you can go in and say, I have a wait list of 500 users, or there are 50 users that are using my product every single day, it's a very different conversation because it's easier to then validate the leading signals for product market fit or for adoption. All right, I'll probably do one more and then continue with the presentation.
Hey, this is Vishnu. Yeah, I asked this question on the chat, but I was wondering, how do we get feedback from on our slide decks or pitch decks? How do we send it to you?
I would say I would divide this in 2 pieces. I would say talk to other founders, and typically founders who've raised money, whether they have been successful in raising money or not successful, almost doesn't matter. They'll have a unique lens of feedback in providing you some key attributes about fundraising or seed decks that are important. And then, so that's one category of people. You can obviously talk to your peers and friends, but they're not the most objective people to give you feedback. But still, I would go through the process nonetheless, because you can prune out some of the most obvious mistakes. So that's the second category. And the third category, which is also a very great hack, is a lot of, so if you look at venture capitalists, take any firm you want. Let's look at Sequoia, for example. You'll have people who are general partners, the people who run the fundraising and own the process and own the decision, ultimately. Then what happens after that is you have this chain of different scouts or people who work at associates or senior associates or principals in venture capital firms. Those are great first point of contacts for you. They can lead you to the general partner who is basically going to make the investment decision. And then the other thing is they are super awesome in knowing what goes on in the decision-making process internally. And some of them will be very happy to give you feedback around that. So those are, like, I would say, another great hack on getting feedback from them. And you can always approach them and saying, hey, I want to connect with you and I want to get your feedback. I'm just starting my fundraising process, but I'm not quite raising yet. And that way, what is useful for them is you become a potential deal flow point for them, because they're looking for startups to invest in, and you get to get an internal scoop or some feedback from people who are actually helping or at least a viewer, if you will, to the fundraising process. So that's kind of how I do it. And then people like myself or other people from the CMU community who've raised money, and I'm sure there are a lot of founders who are willing to help. You can do office hours or something like that that can help. All right, I will continue on the deck and then I'll pause for questions again. I think I have just a few other points to talk about, which I think are most useful for everybody. So we stopped at insanely good pitch. So I'm going to go further on term sheets. So assuming you've run your process, you've nailed your pitch, and you have a few term sheets or one or more term sheets. And what are term sheets is? Term sheets is a one-pager document that most VC firms will send you. You have to sign it, and it's like an intent to seal the deal. Now, there are a lot of books and a lot of technicalities around term sheet. There are a lot of things that almost as a first-time founders feel mind-boggling. So I'm trying here to sort of simplify. Ultimately, there are three things you want to look at. And this is also simplifying this very I'm hand-waving over this a little bit because you should really talk to your lawyers about this. But economics, governance, cost, and close. Typically, if you're talking to a reasonable VC firm who cares about their reputation, once they make a term sheet, it's very likely they will invest. There are times I've seen people redact the term sheets. All the venture capital industry hates it. A lot of people don't do it, but it happens. Like, there's anomalies everywhere, but most likely 90%, well, I would say 99%, nobody's going to redact their term sheet. So if you get a term sheet, it means good news for you. You're definitely getting funded. In the term sheet, it will really talk about three main things. What are the economics, meaning how much money are they going to give you in exchange of what percentage of the company and at what valuation? Generally, there is a math around how these numbers add up. And therefore, if you raise $5 million at a $50 million valuation, then there's a math on how much percentage they will get. And there are some spreadsheets that help you do the math. And I highly, highly recommend that. And if I have the bandwidth as part of the community, I'll actually share my own spreadsheet with obviously no data in it. So you can punch in some numbers and play around on saying, well, if I get 5 million at X valuation, how much percentage of my company will I have to give? But the typical math is the higher the valuation, the lesser percentage of the company you give to the investor. But you don't want to go so high just because you're hot right now, because you can't meet to the demand of growth, if you will. So there's a conversation to be had here. Governance is what rights do they have? If you have an M&A acquisition, how much they can dip in the pot. Your typical lawyer will tell you about this. And then closing costs. So typically, when you close the deal with a VC firm, you pay the amount for your lawyers, you also pay the amount for their lawyers. A lot of people overlook this fact and they get a bigger bill and they're surprised, but you kind of have to pay for both. One thing I will say as a hack in here is once you are in the process of literally pitching, I would also simultaneously start interviewing law firms. And then law firms will be very happy to talk to you. It doesn't matter if you're fresh grad out of college or you're like a 60-year-old person with full experience in fundraising. They bill by the hour. So they will typically have the first call or even first or one or two calls at no cost. You have to tell them what you're doing and tell them you're looking for a law firm and what you're hoping to get out of them. Because you need your lawyer, whichever law firm, to review your term sheet before you sign. You should definitely have them take a look at it. And they, at least to pick a lawyer, the interviewing process doesn't cost anything because for them, they're trying to gain business from you. So they'll always have one or two calls with you. I would typically pick the top 5 or 6 law firms. If you're doing it here in the Valley, if you're doing it in New York or anywhere else, pick the local law firms so I can work in their time zone. Typically, all of these, the top 5 firms have people everywhere. And try to understand and build. This is a relationship business with your law firm again, meaning it's almost like picking a dentist. They all kind of help you with the same thing, but they, if you've gone to enough dentists, you like one dentist better than the other for some qualitative reasons you can't explain. In the case of picking a law firm, it's good to find that qualitative where your relationship works because they're going to help you through this process because you have to find somebody who lawyers are negotiating for you for the company, not you as an individual. So they will always draw the line between telling you what's beneficial for KP versus what's beneficial for the company. And so you want somebody who can have a balanced perspective from both perspectives. So that's typically what you have in a term sheet. The more term sheets you can collect at the same time, the better it is for you. And then of course, signing the term sheet is the close. After that, it takes about 4 to 5 weeks to actually run through the closing process. There's a bunch of documents you have to sign, which is actually incorporation certificate, C terms, blah, blah, blah. That takes 4 or 5 weeks before you actually close. Now, this is probably the most important part of the presentation. I see we're also running a little bit behind time, so I'll try to rush through this. But this is where you look at, I wanted to share fundraising. So far, we've talked about fundraising from a founder perspective. Let's look at it from an investor perspective, right? You want to understand what are the motivations of the investor. And that's true for all VC industry. And why are they trying to find startups to invest in, right? And they're typically looking for a company. So you want to first understand who does the venture capital report to, right? Even like everybody, like the saying goes, everybody has a boss. They are raising money from limited partners. And most of them, for those who don't know, the money comes out of, pension funds, state governments, university endowments, hospitals, colleges, funds from countries. So they kind of, wealthy family offices, that's where the money comes from. They raise a pool and then they have to be responsible to these LPs because, venture capital is a risky asset class, which means whoever is putting money in doesn't expect a return for 7 to 10 years. So you want to understand who are their investors and are they ethical investors? Typically, you want to also know that. And then what they're looking for is, can this company be the next $1 to $10 billion business? Therefore, large market is important, right? Because they only make money through a power law distribution. Are you having some customers or some potential customers to whom you are very valuable? And what is the unfair advantage that you have as a business? Like, is there a combination of an idea and persona? Do you have a unique take? Do you have talents that you are combining together? Is your distribution of the product better on some dimension than other product, right? And clear identification of a market need. And then also typically a company that needs reasonable, like if you're trying to build like SpaceX, it's very hard for I don't know, Tyler, the first time founder from CMU, to raise like $10 billion with no credibility behind it. Like you kind of need a business where there's reasonable capital need. You combine all these variables together, they're more likely to fund your startup. and this is my favorite quadrant that I love in terms of like, I think somebody asked the question on like, how do you make your startup more attractive? Again, something I learned from Mandy, one of the OGs in venture capital world, is your startup, your idea can fit into this 4x4 quadrant, which is consensus, non-consensus, and right and wrong. Meaning, either your idea is wrong, and it doesn't matter whether people agree or disagree; it's a failure. Either your idea could be really right and compelling, but it's been done before a lot of times, right? So this is like if you started like an Uber or Lyft today, people will not be very interested unless you have a unique dimension. Or in fact, Zoom, which we're using right now to have a conversation, actually had a tough time raising money because they were in consensus and right quadrant. People thought this problem is already solved. Of course, at that point, you work hard enough, and because he had, Eric had such a great perspective on why the whole WebEx toolchain sucks, he was able to get somebody to agree on the non-consensus quadrant. Now, of course, the best ideas are category creation startups that redefine the market and fit in non-consensus, meaning a lot of people don't agree, and you are right. And those are the ones we have like outsized outcomes, which is same with like, to begin with, Uber seemed like a bad idea. Why would you get in somebody else's car? Same with Airbnb and a bunch of other ideas, which they seem almost counterintuitive, slightly confusing and hard to begin with. But you're actually right. So don't lose heart if not everybody agrees with what you're doing. In fact, it's a good sign. If everybody agrees, then it's already been solved and you're probably not doing the right thing. And so I would say, like, after understanding your investor, whom you're pitching, you should take your pitch deck, take your idea, take what you're seeing, and think in your head, why does what you're saying fits in the non-consensus and right criteria? And this goes back to the question I was answering before, is the number of aha moments directly correspond to non-consensus, whereas not everybody thinks this is obvious, but then agrees it's logically right. So that's on sort of investor perspective and what do they care about when they're investing. This is super important, I think, and then I'll leave you guys with some tactical tips and then we can do some more questions because we're already at 6. But some pro tips, if you will, are quick hacks, right? FOMO is a big thing, and it's, as much as VCs deny it, it's actually true in the industry, which is fear of missing out. Super important, right? Because it hurts a venture capital a lot more when they had a chance to invest in sort of the next big startup versus, sort of doing a good job on an average returning startup. Like, for example, if I invested, let's say, in Workday, and that was awesome, and I missed the opportunity to work on Stripe. Now, both had great outcomes, but the fear of loss and the actual loss hurts a lot more than joy of gone. We all remember the bad experience much more intimately than all the good experiences, right? Couple things around the fundraising process. There are a few things that you should remember, no matter how out of place you feel or uncomfortable you feel because you're doing it for the first time, right? You have to be very cool, courteous, but indifferent, like almost if the success of your startup didn't depend on that fundraise or not. And that's really how you should think about it, because just raising money doesn't mean you'll be successful anyway. Don't try to over follow up with anybody or propose price because it doesn't help. Like if a VC firm is interested in you, they will chase you. If they're not chasing you, don't waste time on them because they're generally not interested or they can't make up their mind, and it's not really helpful at that point. Don't share which other investors you're talking to. Never ever do that. A lot of people will try to ask you this upfront. You just say you can't share, and that's as simple as that. And then founder signaling, who are you associated with, who vouches for you. These things matter a lot in terms of like credibility by association is a thing in venture capital. And then the only time you can negotiate a better price of valuation is only when you have competition. If you have only one term sheet, you can not negotiate a little bit, but it never works. But more competition is the only time you can get a better price. So that's an important takeaway from an investor perspective. So now we're looking at things on the worldview of investing from an investor standpoint. Again, one of the biggest mistakes two things that I realize is that don't share a presentation in advance. There is no point because, in fact, and some people will give you different advice. So you can treat my advice as biased, but we have never shared our presentation in advance. We've never shared our presentation after the fact with any investors, unless we have a strong conversation that this is moving forward somewhere. Because anytime I'm an investor, I'm looking at a deck, I'm trying to make judgment about and predictions and hypotheses about every single piece without the voiceover. It's like me presenting this, sending this deck and not doing the doc. I'm sure you will not interpret the deck in the same way I have the way to talk about it. You are the person who owns the story about your startup. You know what needs to be built, and there's no point having somebody else do the interpretation for you. So I would say, and this is also a great way for investors to say, if you want to know more about what I'm building, let's get on a call. Now, sometimes a lot of people won't take your call because you don't know them. At that point, if an artifact needs to be exchanged before they can jump on a call, send them a one-page executive summary. And you can literally say, my presentation is literally pictures and animojis and emojis. It won't make sense without my voiceover, and that's fine. Also, always understand that venture capitalists are also hierarchical firms, which means general partners or managing directors. These are the people who are true partners. They have decision authority on making the decision. So associates, business associates, don't try to fake traction for yourself on the fundraise side if you're just not talking to any GPs. They are the ones who make the call. So when I told you in your early stage, it's great to get feedback from the associates. You want to build a relationship because they bring deals to the general partners. Do that early in the life cycle. And if you're towards you want to raise in the next 1 month and you're an expedited time, don't waste time on other people. Just get to GPs. And if you can't get to GPs, move on. And then, of course, warm intros have a much, much more value on somebody paying attention to you than cold calling or email. I would say I wouldn't discourage, like when you're a founder trying to figure a way out, I wouldn't discourage you from any method you can deploy to get what you need to your next milestone. But as a general rule of thumb, warm intros from somebody they trust or a circle of trust or somebody they might even know works significantly better in getting a response than just blanket cold email. Especially don't send cold emails to Mark Andreessen. He's almost like never going to reply unless somebody else who knows him gives an intro. And then we're 5 minutes over, but I'll quickly, and this is stuff that I'm sure I'll share the deck so you guys will have access to it. These are the blogs and books I really recommend reading. Like I have read a lot of material in this space. And if I were to say, how confident am I that this is an exhaustive list? I would say I'm pretty confident. If you can just read through all of this stuff, you'll pretty much have every ingredient from a academic standpoint on what you need for a fundraise. And then you can just use this information later on in the context of what. I mean, obviously, the practicality of getting through the process has a lot to teach you. But these books are great and some great information around that. All right, with that, I think that's pretty much it, what I had to share from a presentation standpoint. I'm happy to stay longer and answer questions now. Let me pull those up to see if I have anything in the chat. But if anybody has a question, please feel free to just unmute yourself and ask. I'm trying to take a look at it. Oh, there was are there any, I don't know, how to negotiate price when approaching the VC? Yeah, so I would say price will be something. So a couple of things around pricing. You want to be very clear, first of all, Manish, on how much are you raising and why, right? So if you're saying I need $4 million, nobody's going to ask you to send this to you, but have a spreadsheet ready for you on figuring out why do I need $4 million? So where you say, okay, hiring 5 engineers with all costs of laptop, HR, benefits, it's like $250K, multiply into 4, some additional cost overall, like $1 million. If that's the case, then have that spreadsheet ready, know what you want to raise. Then after that, at what valuation they want to raise, meaning how much they want to pay for your company, you don't make the first offer at all. A lot of people will ask you at what valuation, and what I tend to say is like, you guys are better at creating valuation because people come up with this stuff anyway. So I would love to hear what you have in mind, and then we have a number in mind, but We want to hear what you have in mind. And then if you're very clear on where you want to land, that's fine, you can share, but I would stay away from discussing valuation. Then when it comes to negotiating price, the only time you do it once they provide a term sheet or a valuation you want to raise. Some people might verbally talk about it before they raise a term sheet. The only way you can truly negotiate is really if you have other offers, and you can say have other offers and they are significantly better. And then that's sort of the structure. Other term sheet is what helps you for negotiation, nothing else. But you can then still always, if you feel like somebody gives you, I don't know, you're raising $4 million and $20 million valuation, you really want 25. You can then propose, like if you're in a small delta, a few percentage from here and there, then you can just say, I want this, and here's the reasoning for that, and come up with some logical explanation, and then that's pretty much it. But if you want to really increase, like 4 million at 20 and you want to go at 50 or 60, that only happens when you have like other term sheets that are competing offers. Because the way venture capital works, by the way, is that for seed and Series A, there's like an industry average on like how much a typical seed or Series A round is, at what valuation are they raising, and like all the investors are talking to all the other investors, or they're reviewing all of this data from PitchBook and all of that. So there is like some, there's no like math to it, but there is an average number, like a 5x multiple or a 4x multiple or a 6x multiple, and any anomalous valuations only happen if you have competition. So without disclosing numbers for Relyance, we had a very highly anomalous valuation for our Series A, but the only way that happened is we had a lot of competition, a lot of people interested in investment. So that's kind of the way to do it. And I saw one other question, so I'll quickly touch on it, on saying key traction and unit metrics when pitching, when you don't have, so I would say, like, for example, if you don't have, if you're pre-seed, pre-revenue, the traction you can showcase to people is who are the companies you talk to, or who are the customers you spoke with, and why do they think this is a good idea? And if you can get somebody to be a reference, that's the traction you can say. So for Reliance, we said, well, we don't have a product, we don't have any customers, but we've talked to about 35 enterprise startups. We found who our potential buyer would be. We described the idea to them, and this is where you have to spend time building those relationships for them to give you 15, 20 minutes. And at some point, we had 2 or 3 people who said, you know what, this is such a big pain point for me, and if you solve it in this way, here's my phone number. If your investor wants to talk to me, ask them to call me. So that's a great hack to show traction as a leading indicator if you don't have revenue or pre-sale. But then you have to spend time finding, and this is true for both consumer and enterprise startups, is developing an idea or a blueprint of what you want and why this solves the problem. And that's why I gave you a checklist of the pre-work, because you'll realize when you do your pre-work, it's super useful to answer some of these questions for both your consumers and your investors, or your potential customers and investors. All right, I think all right, let's start. Okay, great. I don't see any other specific questions pointed at me.
Sorry, I'm back. I had a question that I submitted to the other site, but I'll just ask it again here. My question was, so we've actually kind of felt like we understand that like having a law firm ahead of time for fundraising is a good idea, but it feels like a chicken and egg where you need money to pay a good law firm to fundraise, but then you need to fundraise to have money to afford the good law firm. How, if you don't have money from a previous exit, et cetera, like how would you approach finding your fundraising law firm for your seed round?
Right. So I think so there are 2 parts to it. Part 1, finding a law firm you want to work with potentially is at no cost. So if you go to Cooley or Wilson Sonsini, some of the best law firms, and you find a partner you like because of your research, they will have the first call with you for free. Just so that you can say, we're close to doing a fundraise and we're kicking off our process. We want to find a law firm as a long-term partner for us, and we are evaluating multiple people. They are basically selling you at that point to build their business, because you're going to And that's at zero cost. So you can have conversations with them. And then just line up the people you like more. They will answer a couple of questions, and they will almost spend 45 minutes to 1 hour with you for free, or maybe 30 minutes at least. So it's important you get your question nailed on how you evaluate a potential lawyer to work with you, and how do you like him or her. Once that's done, you just table that. And then once your term sheet is signed, they will work with you to as a firm, because they will only invoice you much later. And then you already have raised your capital and you pay them. So for Reliance, what we ended up doing was we spent $5K to incorporate the company instead of doing it via Stripe or one of the other easier tools. You can do any way you like. Is because there's so much negotiation that happens, and a lot of people end up wanting to reincorporate the company with their paper, the law firm's paperwork, that sometimes it ends up, especially for classic enterprise companies, and ends up being waste of time. So at best, what you're going to spend is $5,000. And if you don't have that kind of money, you can even wait to incorporate your company after even the term sheet. Like a lot of investors know early stage founders are just figuring this stuff out. So they don't care about when the company was incorporated or not. A lot of people will not even ask you. You can just say and you can always say, I'm in the process of doing it. And then you get the term sheet signed. Those guys will give you funding. And that's what you use to pay your lawyers. There's no cost upfront. Now, of course, if you use their consulting fees on the term sheet, that's when they will charge you. But then at that point, if you're at a term sheet stage, you're likely getting funded. So it's fine. And nobody invoices you immediately. And if you're really that afraid, you can always have like an agreement with them saying that I'll let you evaluate my term sheet and we'll only pay you if we close. Otherwise, it's sort of a pro bono case, if you will. But typically, I've seen very rare scenarios where people have said, okay, here's a term sheet, and we're not still going to do it. Unless they find like you were, I don't know, a psychopath or a murderer, they're not going to recant.
Great, thank you. Yeah, I've got to run, but I will probably follow up with you on Twitter because I'd love to keep in touch. Thank you so much for your presentation today.
Yeah, thank you.
So thanks everyone for joining the event on fundraising by Abhi Sharma.